Good morning or good afternoon, wherever you are in the world today. I am Steve Hall, Director of Content and Community with Procurement Leaders, and we are delighted that you have joined us here today for our webinar on supplier risk management in the digital workplace. Two pieces to that topic which I think are extremely exciting for us there. Supplier risk management, vital to organisations. Procurement has a key role in avoiding risk, in mitigating risk, in understanding risk. And particularly with the uncertainty in the global economy, and a key role to play in helping organisations manage supplier risk. And when we talk about the digital workplace, clearly there are many tools that can be used to tackle risk, but it's a jungle out there. How do you understand what you should be doing? How do you understand where the tools can be most valuable? And how do you make sure that the efforts you're making to evaluate vendor risk in great detail can be used, acted upon, and actually drive successful results? So clearly you're here because you know that this is a vital topic. It's very relevant to your organisation. How could it not be? Fortunately for you, we're joined by an excellent panel today who are going to help us unpick some of the bones of this and to really hopefully drive some value for you in attending. We're delighted to be joined by John Webb, who's the Procurement Leaders Head of Strategy Research. John is a PhD candidate from Queen Mary University of London. He's an expert contributor to Forbes, and fortunately for us, as head of our strategy research, he's an advisor to C-level procurement executives on supply chain, SRM, supplier collaboration, and importantly here, supply risk, which is one of his many fields of expertise there. So we're delighted to be joined by John today. Also joining us, we have Gerard Smith, President, Global Risk Management Solutions, or GRMS. He's a recognised leader in providing world-class supplier screening and compliance management services that assist companies in reducing supply chain risk. Prior to joining, Gerard founded Cost Recovery Solutions, one of the largest cost recovery profit improvement platforms. So very excited to be joined by Gerard, and particularly looking forward to his ability to speak to the digital piece as well, as we mentioned. Speaking of digital, we've been working with Paul Blake and GEP for many years, and we're very excited to be joined by them, and particularly the ability to understand the opportunity of a procurement technology platform. Paul is the Associate Director of GEP, and he's responsible for the promotion of GEP's procurement technology platform, SMART. He's worked in technology for over 25 years and has been involved in the development of software solutions since before the advent of the internet, he claims. So we're looking forward to hearing Paul's view. Maybe you can talk a little bit around the long game and what's coming next. So we're very keen to hear from him as well. Great panel. With that, I would like to introduce you to just a couple of the functions on the platform. Just so you're aware, I want to make you aware that this is a live event and we are keen to hear your questions. So at any time during the event, and that starts now, any time during the event you can submit a question throughout the webinar. We'll be running the Q&A in the second half, but any time from now on, or when our panelists are speaking, you can submit a question through that Q&A field. So please do take the opportunity to put your questions across. Our panelists will get a chance to get to as many of those as they possibly can, or potentially follow up post-event. I'll remind you a little bit later, but just to reiterate, use the Q&A function and do get your questions into our panelists. Share your supply chain risk issues and let us know what they can do to help. I would also like to give you a quick nudge in the direction of our webinar survey. We're very keen to hear your feedback so that we can improve our webinars. It will pop up at the end of today's webinar, but it will also appear in the doc. So you can see that pop up if you want to sort of fulfill in the feedback early. So that remains all from me. We're very delighted to bring you supplier risk management in the digital workplace in partnership with GEP. But I think we've heard enough from me and enough of the introduction. Let's hear from our first speaker. I'm going to hand over to Mr. John Webb. John, over to you.
Thank you very much, Steve, and greetings to everyone as well. My main role in Procurement Leaders is to look after our work on what we call strategy research. And that's principally interacting with the community, looking at all things about running the function. Specifically, I'm interested in the third-party relationships, and risk management obviously is a big component of that as well. So within Procurement Leaders, what we like to do is survey and talk to as many of our community members as we possibly can. We are very lucky to have some really leading companies that are very forward-thinking in the digital space as well as this space of risk management in general. So we're happy also to share with you some of the insights that we've gleaned from those conversations over the course of the last, decade really, since we've been running those initiatives. So over the next few minutes, I would like to just tee up the discussion for this webinar by looking at some of the more high-level ways of examining the topic of risk management, because it's a topic that we often find that organizations struggle with, not only from the digital perspective, but also from more of a process perspective as well. And I think it's important for this discussion, when even examining some of the interesting technologies in this space, it's also important to reflect upon our own internal processes within the organization, such that we design them that they are fit for purpose to meet our needs for vulnerability reduction. So I think classically, we can look at risk management in three steps. One of identification. Can we spot the risks or evaluate the potential impacts of the threats that may disrupt our supply chain or procurement operations? Two, thinking about mitigation. What kind of continuity plans do we require from our vendors and suppliers, such that we can provide some assurance for ourselves that our supply chains are resilient to any potential disruption? And lastly, we're looking at the disaster response space. So to what degree do we have a capacity, should the worst occur, to respond to that quickly and to resume production or other operative activities quickly as well? And the interesting thing, I think, with risk management is that mostly within the world of procurement, people are loaded on the first element. I think identification and spotting is often seen as equivalent to risk management with many organizations. And I think this is an erroneous way of thinking about risk management, but it's one which is instinctual for many people. And I just want to make a case why we think that shouldn't be the case, and why we have this proclivity within our psychology in order to look at risk management as if it was risk identification. And when we look at the way of identifying risk, it's often based on this classic risk impact probability matrix. So we're having two dimensions here, looking at probability, high or low, and the impact, high or low. And then we get all sorts of normal areas that we might be familiar with, things like black swans, which are low probability but high impact, or micro risks, both low impact, low probability, all those critical issues, the ones that activate a lot of interests within the organization, so that business critical risks. These kind of risks, I think, often are looked at and explored. But I think often is the case, it's the black swan risks that often attract a lot of attention. And when I get asked by members about the topic of risk management, they're looking for providers, and we're looking for solutions to see how we can spot the next black swan. What kind of predictive analytic applications exist out there, such that the next big uncertain event, the big black swan event, will actually be spotted and effectively evaded. And I think for us, we often think that is a wrong-headed way of thinking about it, because there are a rich variety of root cause analyses, or root causes that may have an impact on more productive areas. So we think about risks in five main areas: price, quality, delivery, legal, and reputational risks. And this is, I think, a good arena in which you can cite business continuity plans. But underlying that, there's all sorts of operational, human, economic, or environmental risk factors that actually generate effects that are experienced at the risk type level. So, for example, if you have an operational risk where you got a new local law, or human risk where you have a cyber attack or something like that, these will manifest themselves in some kind of quantifiable business way. So either you have a delivery risks. Something's delayed because of a lack of personnel in the key supplier site. Or in a reputational way, you'll see all sorts of legal issues there. So do we have suppliers that are sourcing from suppliers that use forced labour or slaves? So it's important, I think, when thinking about risk management, is not only to think about risk identification, because this slide hopefully should give you a wide breadth of ideas about what are the particular root causes that could impact all these business areas. There are many, and we could have put hundreds more, I imagine, on this slide. Really, the message here is that actually, if you think about risk management as spotting particular kinds of threats that will affect your supply chain, you're actually overwhelming yourself with a plethora of different items and events that could occur at any time, any place. Actually, a lot more effective to think about how we can secure supply when just thinking about price, quality, or delivery, or thinking about supplier risk when just thinking about those key areas as well as legal and reputational risk. Another area where we think risk identification perhaps sometimes weakens ourselves a little bit if we think about it as equivalent to risk management is that we often worry about the wrong things. So a few years ago, we surveyed our community, and we generated a very interesting result when we asked them, what kind of risks are you worried about in your supply chain over the next 12 months? And then we also asked them what kind of risks they actually encountered. Where did you see a disruption to your supply chain over the last 12 months? We netted the two off against each other, so we looked to deduct all the risks that they were worried about in the future against the ones that occurred in the past. And this graph really ranks all of those different risk factors. And what we see, the overarching message from this, is that we tend to over-exaggerate the risks that we're going to face over the next 12 months. More factors are on the worry end of the spectrum compared to the area where we are under-servicing the risk. But the other interesting thing about it is the types of risks that tend to be the most over-exaggerated, or those areas of risk that cause us the most anxiety, tend to be the areas which are a little bit more glamorous, and those areas that attract a lot of press attention. So these are things like political risk, the instability of marketplaces, bribery and corruption, for example. They are undoubtedly important elements of any organizational risk management plan, but they're not always going to be the kind of risks that actively have an impact directly on procurement organizations. You might consider these more as root causes, but actually affect those more business risks that we saw on the previous slide. But they're also the types of risks that tend to receive a lot of media attention. And this might a lot of manager activity and action about how they're going to approach risk management. Psychologists call this the availability bias. When you're thinking about solving a problem, you go to your memory banks and you find those items that come to you first. Fortunately, the human mind tends to work in a way that it grabs those more sensational areas of risk management. We're sometimes, when we're thinking about spotting risks, we tend to spot the more kind of dramatic risks which stick in the mind. But there are often, on the other side, risks that we tend to avoid that will tend to under-exaggerate the risks. So on this slide, we've got those at the bottom where it's a little bit more mundane. Adverse weather conditions, for example, or machine downtime. These, you might make a case, as might cumulatively have a greater impact on your overall risk staffing. This might actually provide a greater financial impact than any other kind of risk. So when thinking about risk management, it's often important to try and build a system that actually avoids some of these kinds of weaknesses that occur within the basis of a human being or a manager that's subject to these kind of failings as any other. So the last point I'd like to make just before I lead off to the next panelist is to think about the next stage, risk mitigation, and how we think about building continuity arrangements against unexpected events. But even here, we find that there are some aspects of risk management within our membership, which are somewhat weakened compared to what you might consider to be the optimum. So most obviously, we often see that for Tier 1, people are looking for contracts as providing them the main mechanism for risk mitigation. They're looking for documentation and evidence that the supplier is busy in terms of mitigating against potential risks. Whether that actually provides you any assurance of risk management or mitigation is another matter. But when we think about the next level, Tier 2, and often the site of where most root causes actually occur within the supply chain, we find that at Tier 2 level, almost the entirety of the responsibility is outsourced to the supplier. So as a consequence, often when we're thinking about planning and building a robust strategy and continuity plan, we're actually denuding ourselves to a certain extent of one of the major sources of the risk that occur within the supply chain. And actually we need to think about level 2, Tier 2 suppliers, as well as level 1 suppliers, but also thinking about something a little bit more robust than just paperwork on the supplier side. So are we actively auditing key suppliers? Do we have a regular flow of information directly from some of their own ERP systems, for example? There are some clear weaknesses here within the experiences that we found in the procurement leaders community. So firstly, we often see and equate risk mitigation and risk identification as being equivalent to overall risk management. But also we see that when we engage in risk mitigation, there are also some clear weaknesses within our community that look at areas of over-reliance on documentation and even over-reliance on the documentation that comes from the Tier 1 supplier. So hopefully that provides a little bit of an overarching framework for the discussion that we're going to have here about where we cite risk and where the different elements of the risk manifest themselves and where they also make themselves known within the procurement leaders network as well. So I'm happy to hand over to the next panelist.
Thank you very much, John. Really interesting overview there, and a really useful kind of way of thinking about risk, particularly, perhaps busting some of the preconceptions that people might have around it. So very useful there. One thing I think it's important for us to talk about, though, is this idea of integrating the information and data gathered around suppliers into a risk strategy and kind of understanding how that can help drive screening, compliance, etc. Fortunately, we've got with us Gerard Smith from GRMS. Gerard, we're very excited to hear what you have to say. Over to you.
Great. Thanks, Steve. John brought up a number of very good points that when you're speaking of supplier risk, it involves both financial but also reputational risk, and we need to look at both sides of that. And remember that it's not just risk identification, but risk management. We want to be proactive about managing risk and reducing risk in the supply chain. So let's go over what the problem is. In our experience, most companies have difficulty monitoring their suppliers either because of limited internal resources and the costs associated with supplier risk management. It's also challenging to keep up with the existing regulations because new ones are being added every day. And a good example would be in 2016, there were over 1,200 international government watch lists around the globe. By 2017, there were over 1,500 international watch lists. And each of us that are in procurement or in supply chain should be concerned about doing business with any company on any watch list around the globe. So it's important to figure out a way to manage to all of the different various governmental watch lists. We also know the collection and management of the certificates of insurance creates one of the largest areas of exposure for companies, as you can see on the slide. Literally every client that we've worked with, there's always over a 90% non-compliance rate. In other words, where a company will say the supplier is supposed to have a certain amount of insurance to protect you, the buyer. It turns out if someone actually focuses on that and looks at the coverages, etc., that there's non-compliance. Domestically, in the United States, it's called certificates of insurance. Internationally, it's called evidence of insurance. But it's important, again, to manage to that. So being proactive about solving this, not only reduces the risk of high penalties for noncompliance, but also the serious risk of financial loss, to John's point earlier. So I like to use a few examples to kind of give you an idea of what I'm talking about. Here's an example of a list. In this case, it's the U.S. OFAC list under the Patriot Act. And I ask companies often, which of these companies do you think are actually on the OFAC list? And the answer truly is most companies just pick one or two, but the reality is every one of these companies are actually on the current OFAC list. So you can't judge a company by its name, because if you were doing business with the Car Care Center Company or the Educational Development Association, you potentially could be hit with a very large fine if you're doing business and you're a U.S.-based company. So there shows you one example. We can't rely on the company name to try and manage that. So another example then would be this, which is the non-compliance statistics based on our experience with various clients. And if you can imagine managing over 1,000 or 10,000 certificates of insurance on a spreadsheet with different policy expiration dates, this is where this becomes a big problem. There's also several different types of endorsements and combinations of endorsements to manage to ensure that suppliers meet your requirements. So this can be complex and time-consuming. The other thing to note is the additional insured language has to be perfect, in other words, worded perfectly, or you have no coverage whatsoever. So again, the certificates of insurance or evidence of insurance becomes a very valid area of risk for companies. And this one's a U.S.-centric example, but it really applies anywhere in the world for those that are around the globe. U.S. companies need to ensure that the name and the TIN, the tax ID number, provided on the W-9, which is the tax document, matches the IRS tax filing records. And if not, these are the penalties. So it can be significant. Every company has its own tax documentation. The requirements of collecting that information and proactively managing it, again, is an important issue. So here are some various risk issues that companies have brought up various times, saying these are very important ones, again, and reflecting back to what John showed in that bar chart. But monitoring the financial stability of suppliers becomes one of the biggest issues. A lot of companies use companies like D&B, Dun & Bradstreet, for information, but the problem is that's primarily self-reported information by the suppliers, and it's normally refreshed maybe once a year. So the problem is getting current information and being able to manage it, again, proactively versus getting old financial information and making a business decision may get your company in trouble. We talked about the certificates of insurance and making sure that on a daily basis that the supplier doesn't cancel the policy, et cetera, so that your company's not protected. Complying with the governmental watch list, we've talked about this earlier. There's over 1,500 governmental watch lists around the globe that each of your companies need to manage to. So they need to be identified and managed to, which is, again, a complex area. The diversity status is interesting. In the past, a lot of companies allowed their suppliers to self-certify, meaning they could say, I'm a minority-owned or woman-owned or whatever it might be. In today's environment, most companies now require that the suppliers certify with one of the certification agencies around the globe and then produce a certificate proving that they are indeed a diverse company. And so this is, again, another document, another piece of information that you have to gather and manage to. So determining the best approach to manage and monitor suppliers is becoming a big issue with various different companies. And the fact is that there's a variety of different ways to manage. So we looked at this and, we're actually out of order. Well, we'll go with this. Okay, so this shows an example of what a dashboard looks like in terms of what the information you want electronically. So I just simply use this as a screenshot. So this is a client, what we call a client dashboard, which allows you to track the progress of the program using the 6 icons, whether processing, pass, alert, fail, other, etc. It also shows you upcoming re-enrollments in the next 90 days, which of your suppliers should be re-enrolling in the program, because you need to re-screen or reassess each of your suppliers every 12 months. And the reason for that is you have to collect new documentation, you want to continue to monitor those suppliers, etc. So it isn't a one-time when you onboard them that you screen them, but you want to do it on a continuous basis, whether a daily basis or an annual basis. And then the past 2 re-enrollments show you very specifically which of your suppliers have not gone through your assessment or supplier screening program to ensure that you're not giving them additional business if they're creating a liability for your company. So this shows you one of the screenshots. This next screenshot shows you a supplier dashboard assessment, or what's called a detailed view, which then shows you some of the examples of what information that should be on the platform, which includes not only the company contact information, et cetera, when they went through the screening, but more importantly, each of the different what we call risk components, whether in this case bankruptcies, liens, and judgments, or the certificate of insurance, or diversity. Each one of those not only should have the pass, meaning compliant or non-compliant, but then when you click on the arrow, it opens up, and if it says it's non-compliant, it needs to provide you the information why, so you can make a business decision whether you are either saying that it is acceptable or it is not acceptable. In other words, in the case of the bankruptcies, liens, and judgment, it shows past exemption granted, means that the company, the supplier in this case, filed bankruptcy, but it's recognized and we want to still do business with them, so we give them a pass. In the case of diversity, it says it's failed because it's expired. So each one of these, it should provide you the information of exactly what the issue is, and you determine then whether it is a problem or not. Then this final screenshot shows you what's called a risk summary report, which shows all the suppliers. It also shows the status of each of the different risk components. So it shows when they enrolled by, and then each of the ones that are color-coded, it shows you exactly what the status is, whether there's a problem, and then when they need to re-enroll by. So that just gives you a few examples of what a system should provide you information-wise, so you can provide reporting to your management. So let's talk about the evolution of supplier risk assessments. We've broken it down to basically 3 phases over the last 20 years. The first phase is basically where I was. I was in procurement 20 years ago, and I was working for Northrop Grumman, the very large aerospace company. And we were self-performing, as we call it. In other words, we would collect the certificate of insurance, the tax documents, the terms and conditions, safety documents, all of that. We'd pull a snapshot report, in this case a Dun & Bradstreet report, and then we promptly put it in the file, close the file, and forget about it. Because at that point, we were self-performing everything and we didn't have the time to manage it. So that didn't work out very well for a lot of companies for a lot of reasons. So a second phase evolved, which is the data subscription services like Dun & Bradstreet and Thomson Reuters and others that are basically what we call data sources. Now, a data source provides inexpensive raw data which has not been adjudicated or verified. In other words, they're buying and assimilating the information and then they're selling it. It's typically not continuously monitored, but then it provides them the information basically at a moment in time. So that evolved to a third phase, which is really what GRMS created, which is a technology-driven service company, which includes the adjudication of the data, but also more importantly, assisting the suppliers to get into compliance. So what that means first is taking data and managing false positives. In other words, a company says, that's not my company, or I don't understand what the insurance requirements are. The question that we're always asking companies is, who do they call within your company if they don't understand the insurance requirements, or why the tax document isn't correct, or a specific issue? What do you mean my diversity status has expired? What does that mean to me? So what we've done is we've created a way to assist the suppliers to get into compliance with what your requirements are, being that they can call a help desk and say, this is the problem, I'm not sure what the insurance requirements are, why we don't meet them, can you give me some advice how we can get into compliance? The third bullet is the most important. It's now possible, because of technology and a variety of other sources, that we can continuously monitor a supplier on a daily basis. So if their diversity status expires, or if there's negative media, or a company suing a supplier, or that their insurance has expired, or whatever the case may be, we can actually push a flag into the GEP platform or any platform and be able to say basically that there's an issue with this supplier, you need to look at it. So it's literally push notifications straight in the GEP platform, and then it notifies you that there's an issue with this supplier and what the specific issue is, so you can act on it. So for the first time, you're able to proactively manage your suppliers versus finding out they filed bankruptcy last month. So this is a very different way of doing business, and this is where technology is a big part of it. So we have identified 5 key components of what we call a world-class supplier risk assessment program. The first one, it has to have the ability and the flexibility to be able to customize the different risk assessment programs for different types of suppliers. It can't be a one-size-fits-all. It has to have the ability to manage either based on geography or risk or spend or direct versus indirect or whatever you want, but it can't be a one-size-fits-all. The second point is the adjudication of the information. This is where we're talking about adjudicating all data returns for false positives. In other words, if some company pops up someplace, then how do you solve it? And I'll give you a quick example. Dun & Bradstreet was asked by a Fortune 100 company to check their 80,000 suppliers against the what's called the OFAC list here in the United States. And basically DNB pinged the list and then came back to the company and said, you have 7,000 potential matches. It should have been 1 or 2. It's 7,000. Well, why did that happen? Because DNB is a data source. They can't adjudicate the information. They can't verify it. So they pinged it, and they said, well, if Acme is on the client list and Acme is on the OFAC list, it must be the same company. Obviously, it's not, but that's what happened. Then the company was in a panic because they called us and said, how do we clear 7,000 suppliers instantly because we can't drop all of these suppliers. It's too many. So this is where you run into trouble where it's not adjudicating the information. Document management, the system has to have the ability to validate all the documents. In other words, collect and validate documents. And this requires a service. In other words, you have to be able to put human eyes on every document, whether it be a tax document, conflict minerals, California transparency, the certificate of insurance, obviously, whatever it might be, but it requires a human intervention, which is why it's called a service versus a data source. So you need to be able to look for a service that can actually manage these documents, and it should be able to collect any standardized documents, in other words, safety documents or terms and conditions or whatever else. The reporting capability, we've worked with GEP, so we have the ability to produce reports, sort of summary reports of the data, that the different risk components, et cetera. And then the fifth part is this continuous monitoring. The key part here is the verification of supplier information in real time. In other words, if there is a change of the supplier's status in financial stability or in insurance or whatever else, you need that information now. You don't need it once a year when they're in trouble or et cetera. So through this partnership with GEP, literally you're getting this information continuously pushed into the GEP platform, which is why this partnership is so important. So here's some specific benefits. One of the biggest ones is the ability to rationalize, meaning standardize your supplier base. It'll identify if there's issues with your suppliers, and if there are, you might be able to aggregate to other suppliers. So that hopefully gives you a little bit of an overview of some of the value proposition of setting up what we term a supplier risk assessment program with different risk components for each of the different suppliers, and then we produce what we term the risk rating. So risk rating is what's pushed into the GEP platform with each of the components listed, and then the status of each of the components. And if there is a non-compliant component, it identifies what the specific issue is. In other words, it's negative media. There's a negative story about this company. We managed over 25,000 or 35,000 publications around the globe. So if your supplier pops up on one of those publications, it provides you a link to that particular story to determine if that is a particular issue that should concern your company or not. So again, this proactively managing is a big part of the value proposition. So with that, Steve, I'll turn it back over to you to have Paul take it from here.
Many thanks. Very much appreciate that, Gerard. Paul, one of the things that we wanted to talk about was is really kind of getting under the skin of the process and how to integrate risk data into the source to pay process. So I think there's a lot of interesting stuff ahead from you. I'd like to hand over then to Paul Blake from GEP. Paul.
Thank you very much, Steve, and thank you, John. Thank you, Gerard, for the great presentations going before. Hello, everyone. This first slide I've got here is called the technology problem with risk assessment. Is there a technology fix to supplier risk management? No, absolutely not. Can you do it without technology? No, absolutely not. There are some very interesting things that are afoot in the market today. And indeed, the very first question that was asked by one member of the audience today right now is what is meant by digital workplace in the context of this webinar? We're talking about supplier risk management in the digital workplace. So what I'd like to do in this segment is to unpack that a little bit. and look at how what Gerard has just described as being the human intelligence element of supplier risk management, the critical part of that, the divorcing of data from the process and replacing it with actionable intelligence through the use of human activity, integrating that with a software environment, integrating that into the digital platform is what is going to make supplier risk management far more achievable and far more successful in the future. What prompted the discussions which have led to this webinar was the challenges that we're seeing many organizations face when it comes to managing risk on top of what they already have to do today. Now, to my mind, I think there's a productivity crisis in the workplace today, right across the board, not just in procurement, but right across the board. We want to achieve more. We want to increase bottom line value, and in procurement, we want to create more savings. We want to get a better handle on risk, but it's hard to make any headway in that when we're being asked to do more with less. And we're not even talking about trying to achieve more with less. Many organizations are finding it hard to even achieve the same levels of productivity as they used to, and they're finding it hard to even achieve more with more. In the last couple of decades, we've seen technology come to the fore in the workplace and achieve a critical mass. It's become where we work and what we do. And in the 1990s, desktop computing became commonplace. And over the course of the last decade, we've seen significant changes, significant movements in growth. This is some data from the Office of National Statistics, and which is, if you don't know, is the UK government's data line, data processing organization. And this line shows you that for the first half of the last 20 years, there has been a steady upward trend in productivity measured by a complex combination of gross domestic product and gross value added to the economy. And you might expect quite reasonably that trend will continue to grow, and that now we should expect to be 50% more productive with 50% greater output than we had at the beginning of this millennium. You might reasonably also expect that around the end of 2007, 2008, that we would see a dip in productivity as a result of the global financial crisis, but that it might return to some kind of normality. What we've actually seen is a steady flatlining of productivity and output over the course of the last decade. It seems to me that almost at the time that workplace technologies hit saturation point, productivity growth faltered. Much of that may be due to the slow recovery from the global economic crisis, but I believe there is another factor at play here, which is the reason for introducing this piece of statistics to you right now. Perhaps the technology we have been using imposes fundamental limits on how effective we can actually be. Whereas the first flush of digital technology had a great and positive impact on productivity, perhaps we've reached some kind of limit. And getting beyond that will require not us doing more of the same, but doing something new. I have to be honest with you, I cribbed this graph from a presentation that was given at a conference that Steve and his colleagues at Procurement Leaders were running last year, and I felt it so compelling that I had to use it myself. Another conversation I had at that very same conference was with an executive from a world-renowned high-tech manufacturer who told me that the fundamental bottleneck on their ability to deliver new innovative product was the rate at which they could construct new manufacturing facilities. And that rate hasn't changed for 50 years. It is such a limiting step that they have to start building their factories and plants years before they finish developing the products that they're going to build in those plants. And I had to ask him, does that mean that sometimes your factories, your plants are not fit for purpose because the product has outpaced the model for construction? And he said, very often, but what choice do we have? And that, I think, is the great analogy of what we're seeing in the workplace today. The limitations of our technology can fundamentally act as a brake on what we're able to do on our productivity, despite them being a previous source of that growth. Today's workplace technology is built around three pillars of email, documents, and standalone applications. And that's imposing limits on how effective and how efficient we can actually be. There is a traditional notion that people, process and technology are the sort of three pillars on which business is built, and that you can re-engineer any one of those in isolation. But my notion here is that that is wrong. That's plain wrong. The case I've made is that it is people using software that determine the process that can actually be followed. Don't get me wrong, the technology that we have has largely driven the growth curve that we've seen over the past 2 or 3 decades, but now we're hamstrung by it. I believe that in order to be able to get to grips with risk management as a critical factor, but one which hasn't been given the attention it deserves, we need to find additional resources and brain power, and that's proving impossible while we're locked into a limited way of working. We don't have those resources spare to be able to apply to it. Effective risk management will not be so much for what software can do, but from what it can free us to do. And as Gerard has already pointed out, it's not data you need, it's actionable intelligence. But you also need to be free to act. You need to have the time and the resource to be able to put in those programs of mitigation, not just collect the raw information. So just to move on to that a little bit further, I'd like to take you through the standard procurement process and look at how the traditional approach to where technology plays in that as being a real break on how we can manage supplier risk more effectively. So very, very quickly, straightforward process. We all know about the procurement process, I hope. We look for opportunities by investigating what goes on in the past. We then develop plans and strategies to deliver against the potential value we've identified. We then execute on those plans through sourcing, negotiation, and dealing with suppliers. We then encapsulate the terms that we've agreed in as part of the sourcing process into contracts. We then have to manage the supplier relationships and manage the risks to ensure compliance with the contracts and to minimize exposure. And then we need to exploit those contracts according to the terms that we agreed. So all of this is about building the potential for savings, the potential for value through setting up a relationship with the supplier. And it's when we exploit that relationship through actually using the contract, as long as it's compliant with the terms we agreed, that's when we can realize savings. But this process breaks down. And it breaks down fundamentally at this point. It's the division between when procurement have done their job in getting a contract signed and having a handshake on the best deal possible, and then actually using it, the operation of the contract. Maybe the business is unaware that the contract exists in the first place. But more importantly for this argument, supplier relationships can be left unmanaged. Suppliers can be unmonitored, the terms can become lost, there can be fraud entering into the picture. All sorts of different things can become problematic. But our traditional approach to how we apply technology to this process has been piecemeal and siloed. We might have some very advanced tools to allow us to do data analysis and to identify opportunities, but then we start to break out into different areas and different tools. And very often when it comes to looking at supplier risk management, supplier relationship management, there's very often nothing that is specific. It's spreadsheets or documents or even just emails that are used. Even when we have situations where we have a system as advanced as that as GRMS, where there is human intelligence being applied to provide all of that adjudication, how does that integrate into the rest of the landscape that we're trying to work with here? And this is where we come to the idea of a digital workplace. In order to remove this huge area of supplier risk management from being something that happens elsewhere, something that is somebody else's responsibility, we need to find a way to integrate that into the modern workplace. The digital workplace is a concept that has been created by leading people in the IT organizations of major corporations around the world as being the new paradigm in how we can work. A unified workplace based on integrated systems that allows for more straightforward information sharing, more straightforward work processes. And in a procurement sense, what we see as a unified workplace is somewhere where every stakeholder, from the procurement team to the end user buyers, to the executives, to the suppliers themselves, can interoperate and collaborate in a single environment, which allows them through consumer-grade usability, through unification of workflow, to take advantage of the emerging technologies. And in the case of supplier risk management, integrating that kind of intelligence that we saw Gerard talk about just now into a digital workplace will allow the procurement team to act as almost with a radar, to sweep out across the whole of the landscape to find out where the risks are and to introduce that notion of risk mitigation and risk management. And this is something that we're seeing echoed by people like John, who spoke earlier, the approach that the evidence seems to be putting everybody towards. And in a report that was published just this week from A.T. Kearney, there's a quote that says, "What is needed is a layered, pragmatic approach that uses the best available tools to filter out information noise, capture valuable information, and create powerful insights long before the luck runs out." That's very interesting. It is that notion of a layered approach, of actually integrating not just data, but intelligence into a system where you can actually look at everything in the round, this notion of a 360-degree view of a supplier or of a category or of an entire supply chain. We commissioned some research ourselves recently, and a couple of the data points I'd like to pick out of here about supply chain risk are very, very interesting indeed. Only 3% of organizations are looking at addressing supply chain risks through a single automated workflow that facilitates risk assessment activity between stakeholders. It's a tiny amount. Why? Because I fundamentally believe the tools don't exist or haven't existed until very recently to allow us to do that. When everything works in standalone applications, when we're locked into that email document application way of working, it's very, very hard to find the time, the resource, the budget to build a system that allows you to do that. And coincidentally, the tiniest percentage of organizations have a CPO who thinks that it is their role to own supply risk. And yet I think that's exactly where it is. Procurement has the opportunity, with the digital workplace paradigm that is happening today, to introduce the notion of a single automated workflow that pulls in that human intelligence from the likes of GRMS and to take ownership of third-party risk. So this is what I mean when I talk about supplier risk management in the digital workplace as being a wholly new way of working, and really I think will be core as part of the procurement transformation journey that so many organizations are starting on and wanting to get on. So to return to that notion of these three ideas, the old school notion of risk management being three parts, measure, monitor, and mitigate, I think is misleading, because all of the focus, all of the attention, all of the resource and budget has been applied to measuring. So as John said right at the top, it's capturing the data and thinking that that's the job done. Even if you put in a program of monitoring, that isn't enough in itself. It has to be all three working together. And so the three M's need to be replaced by a single M, which is manage. We need to be able to manage risk more effectively. We need to be able to integrate the data with what it means, with the creating actionable intelligence and bringing that into an environment where we can see it, where we can act on it, when we can integrate that with the rest of that source to pay process, so that as the certificates of insurance are going out of date, we can act, we can mitigate the problem before it becomes a real problem and not interrupt our process of value delivery. So that's my piece. I've gone through it as rapidly as I can. There's more that we can talk about, I'm sure, but Steve, I guess we should be getting on to our guests' questions and answers.
Absolutely. Thank you very much, Paul. And you know, we're very excited to have this panel put together, so we've tried to kind of pack in the content, but we've left a little bit of time to kind of crack into those questions. So thank you to those who've sent us across questions. I'm going to kind of dive into these guys, and I'll assign them, but let me know if anybody wants to kind of add an answer in there. So a question that's come in, and I think possibly, Gerard, this one might be, I'm thinking this might be most sort of relevant to you. What would you consider as the most critical aspects or information that make up a supplier risk profile, e.g. geographical location, reliability, level of transparency, backup assets? Can you maybe give us a bit of a read, Gerard, on that idea of a supplier risk profile and how you guys kind of understand those different components and their value?
Well, I'm going to reframe it slightly from a risk profile to a risk assessment. In other words, there's various different things that should be assessed. What it includes can be a variety of different facets, from regulatory to financial stability to social responsibility to cyber to reputational protection. There's a variety of different areas that should be included, but ultimately the risk assessment comes down to, did they meet the criteria or not? And then to what degree in some cases. In other words, there may be certain things that are variable, but in most cases it's black and white. Did they meet the requirements? Do they have the insurance that we require? Are they on any governmental watch list? So it's black or white. So I would suggest that you identify what risk components are most important for your organization based on your particular requirements in your industry. You know, like I said, it could be regulatory, it could be reputational, it could be health and safety. There's a variety of different things it can include. But ultimately, it comes down to, did they meet the requirements? Are they compliant or are they not compliant? So does that answer your question, Steve?
Yeah, I think that's a useful piece. And obviously, it's impossible to kind of go, yep, this is exactly bang on how you need to do it. As you say, it's going to depend on who's asking the question. So I would, another question then, let's throw this across. Paul, maybe you can have a tackle at this, and then perhaps John. Question that's come in: what do you see as a differentiation between due diligence and risk management? What do you see as the key challenges for introducing a risk management framework to a global procurement organisation? Paul, any thoughts on that differentiation between due diligence and risk and building that framework?
I think the challenge is, for me, it seems to be the same that applies to all supplier-related activity. You know, it's duplication and lack of synchronization across a business that causes a lot of the problem. The process and the policy can't exist in isolation from the systems that are supposed to support it. You know, this is the point about people and technology working together, defining what the process actually is. You know, if we're going to introduce a risk management framework right across a global organization and overcome, you know, the challenges which are there, it can't be just set out as a process document. It can't just be, this is what we're going to do. Because if the tools you have don't let you do that, you won't do it. It just won't happen. That isn't how people are actually working. You know, any process that, you know, is 14 steps or whatever it happens to be, if the software and tools that people are using don't cover a particular couple of steps, people won't find a workaround generally. It's not through malice or through negligence. It's just that isn't how we work. So there has to be an easier route to actually getting to through the due diligence phase of capturing the data and of putting the certificate of insurance into the supplier record for the first time, and doing that on an ongoing basis. And that's all about, as I said, bringing together technology that works how people work and provides them the insights to the information they need to know, not drowning them in data and raw information, but giving them actionable intelligence. And Gerard's model of the simple red, amber, green flags, you know, goes a long way to changing how people actually interact with software when it comes to understanding what to do next.
Excellent. Thank you, Paul. John, I'd like to focus on the latter half a little bit, just to get a view from you and what you've seen with PL. As the question came in, it was, what do you see as the key challenges for introducing a risk management framework to a global procurement organisation? Are there any, I mean, you touched on quite a few ideas in your presentation, but are there any that really jump out to you as being big challenges that organisations often struggle with when trying to get their head around what a risk management framework is and how to implement it?
Yeah, sure. It's a great question, and I think that the way that the original questioner asked that was by looking at the distinction between due diligence and risk management, and I think that provides a little bit of a hint for the answer about the challenges that organizations face in implementing and introducing a risk management program. I think the issue sometimes with risk management is that due diligence is a way of thinking about it that converts the activity into a tick-boxing exercise. So often we think about doing due diligence in supplier onboarding. So what kind of supplier checklists do we have? Have we asked our buyers to go through the various different tools and check through those? If they have, that's a box ticked, and therefore we've done what can be reasonably be asked. We have completed our risk management, but actually at the end of the day we haven't successfully avoided or prepared our organization for any kind of potential threat that might disrupt the supply operations. And I think by contrast, risk management really needs to be much more proactive. It's often intelligence that requires someone to look outside the process and look at the underlying root causes and potential business threats that face their organization. But also increasingly we're looking at more predictive capabilities of the marketplace as well. And so I think when organizations think about risk management and where they struggle to implement those, I think it's often that distinction between something which is a lot more process heavy, a lot more focused at just ticking the boxes for buyers within their category plans, and not having that wider, more intelligent perspective about really what is generating potential threats or disruptions within our supply operations.
Yes,
Great answer, John. Thank you very much for that. Oh, please,
if I could jump
go.
in. Also, I think due diligence is gathering information, but risk management, to John's point, is being more proactive in terms of proactively managing your suppliers. And I know sometimes companies come up with, well, we know we need to manage it, but how do we pay for it? And it can be client funded, it can be supplier funded, it can be a combination thereof. But ultimately, the responsibility of these risk assessments falls on procurement to manage the risk. So again, due diligence, I think, is more a reactive versus a proactive approach, which I would term risk management or risk mitigation.
A useful distinction. Thank you very much for that, Gerard. We're a little bit pressed for time, but I wanted to see if we could tackle a couple of others quickly. Gerard, I'm going to stick with you. One question that's come in, I'm going to read it as it is. Other than financial indicators and SLA agreements, what other indicators could highlight supplier difficulty? Can you give us an idea then perhaps of anything that people might be considering including and understanding better as an indicator?
Well, it depends on what industry and what the company does. When it comes to regulatory, it could be everything from conflict minerals declaration or REACH and RoHS. When it comes to health and safety, it could be HSE questionnaires, EMR ratings, etc. Social responsibility can be anything from diversity verification to slavery and human trafficking, sustainability, those type of things. Obviously, cyber is a big deal these days, so creating a cyber scorecard and maybe collecting a security questionnaire, all things that procurement needs to look at. But again, this is where we kind of, we talked a little bit earlier about specific modules or areas, whether it be regulatory or reputational or social or financial. It's basically looking at your program and saying, what type of program do we need to manage our strategic suppliers, and what is the minimum requirements that we need to manage our tail or our 80% of suppliers? What's the minimum we need there? Before we issue a PO, maybe we want to know they're financially stable. Maybe we want to make sure they're not on any governmental watch list. So that's kind of a difficult question to answer because there's literally 50 different factors you can incorporate in a supplier risk assessment program, but it needs to be unique to your company because each company has its own unique requirements.
And I guess it bears home the point, it isn't one size fits all, and you have to do your homework, I suppose. One more question then, and maybe I'll throw this to you first, Paul, and if we've got time, perhaps John as well. Paul, how would you get category leaders who don't see supplier risk management as part of their core role to sit up and pay attention to it? Any thoughts there?
Yeah, it's interesting because that goes to that chart I had earlier, which showed that the only 2% of CPOs see supplier risk management as being their problem. Everybody thinks it's somebody else's problem or should be, and I think that's because we don't traditionally have the bandwidth to deal with it. There's so much else that a category leader needs to be doing. And supply risk management could take the whole of the rest of their working life if that became all in their basket, so to speak. They don't see it as part of their role because it hasn't been, and it hasn't been because it's too hard. And the day-to-day tasks have taken priority. So I think the secret to that is to be able to give people who own the category or people who own procurement or own the supply chain the bandwidth to be able to do it. And the way to do that is to automate what you can in the rest of the process, not talking about supplier risk management, but talking about all the other stuff that's going on, all of the procurement and purchasing and document handling, take advantage of the latest technology to automate all of that. Use service providers like GRMS to do all of the heavy lifting on the adjudication and the aggregation of the intelligence. And that will then free up the resources that you have, the very valuable professional resources you have within the organization, to then action that intelligence, to then take ownership of it.
John, thanks very much for that, Paul. John, anything as a final, very quick thought on getting people within the category organization to understand supplier risk management better? Any final thoughts or tips there?
Sure. I think one of the unfortunate realities of the world of risk management is often for companies that risk management is something that organizations do after a crisis has hit. In between those times, there is, unfortunately, it just tends to be forgotten about, and it's not something that necessarily activates much interest or energy until there's been some real hard evidence that this is something that we're generally facing. So I think don't waste a good crisis is often a good way of thinking about these things. As soon as something does strike, it's an opportunity to really compound and drive the capability within the organization for risk management. But also, I think as one more contribution to this, and something that we haven't really spoken about too much, is actually what are the needs of the business? What are the needs of the category stakeholders? They're often thinking about risk management too. They're often thinking about the kind of threats that will disturb their own operations. And so actually tying in some category manager objectives and activities into speaking to the risks that most engage the stakeholders is another way into this, to thinking about really engaging perhaps a reluctant category force to take this seriously and to look to mitigate and reduce any risk exposures to the organization.
Great, a call to action there. Appreciate that, John. Excellent, guys. I appreciate we've run over a little bit, so just a quick wrap up from me. We had a lot of people asking about the slides. Yes, the slides will be made available post-event. You will receive those if you've registered. And finally, before we go, I'd just like to thank our speakers, John, Gerard and Paul. Thank you very much, guys, for putting excellent presentations together and for joining us for the Q&A. Really appreciate your effort there. And, of course, thanks to GEP for partnering with us to bring you this exciting topic. Thank you to the audience for joining us today and for making this an engaging session with your questions. And, of course, if you have any feedback, please do use the doc there. Please do submit your feedback there. Thank you very much, and please do join us again next time.